Hi everybody, this is the investing teacher, high school science teacher, teaching others how to invest. In this video I'm going to go over some advanced wheel strategies. I did do an intro video to the wheel a few weeks ago. There's a link down below to it. And in this video we're going to go over where to pick your deltas, when to possibly roll up or down and out, and when to trim or manage your position in the middle of your positions. Let's get to it. Okay, here is how to implement the wheel strategy in a more advanced plan. I did leave a link to this document down below in the video, so feel free to look at it when you need to. First, you want to be able to find a stock you wouldn't mind owning 100 shares of. So look for stocks with high implied volatility and also more premium involved. High implied volatility means that the stock options are actually more valuable because the stock is going to be moving more. And then that would allow more premium. At this point, you're going to sell a cash secured put 30 to 45 days out, just like before, and a delta of around 0.3. If you are more bullish and thinking the stock will go up, you could go up to about 0.5 or so, or then it's essentially at the money. So let's say that the stock's at 30 and you're selling a cash secured put at 30. In this case, though, there's a good chance that it could get called in, and then you'll have to buy the shares at 30. Obviously, if it gets lower than that. Then you're going to write your cost basis just like before. All right, so in order to figure out your cost basis, let's say the stock is currently at $30 a share. You receive a dollar premium for selling the cash secured put. Your cost basis would then be $29 per share. Obviously, it's $1 less. What this means is, let's say the stock goes exactly down to 29 at expiration. You would have to buy the shares at 30 because you sold the cash secured put at 30. Then the stock's at 29, so you're down $1 there, but you received $1 in your premium, so you'd be at break even. Now, let's say that you sold the cash secured put, say the stock's at 30, let's say you sold it at 25, and then it goes to 26, 27 pretty quickly. At this point, is a little bit more advanced strategy, and I put it in blue here. If you're close to the signed stock, close to your expiration, you want to try to buy to close that put, so get rid of that position, and then sell another put down and out, away, further out in expiration. Ideally, you can make a net credit for it. So you might need to go quite a bit farther out than possibly even 45 days in order to do that. So let's look at an example drawn out of how this works. All right, so in this case, let's say I have a current price at 30, that's in blue, and then I make a cash secured put at 25, that's in green. So this purple line I'm going to draw will be where you made your expiration. And let's say that could be 30 to 45 days out. Now let's say the stock price goes up, then goes down, and then drops down very quickly like you see in the blue line here. In this case, you're going to want to consider selling a cash secured put, buying to close at this put, and then selling another one further out in expiration even lower, because you're worried that the stock could go much lower than 25 and it'll be down. So you sell a buy to close at this moment. You're going to try to do this close to when you're already at the strike price of 25. You want to consider going out and also lower in your strike price. So you might have to go to the line over here. This might be a few months out instead of just 1 month or so. And let's say we're going to sell a new cash secured put at 20 instead of 25. Now, in doing this, you might be negative on the transaction. So try your best to make sure that you can get a net credit. So let's say the initial buy to close, let's say your initial cash secured put was $1, and then we're going to buy to close it. It's going to be worth more money, so you're going to be at a net loss. Let's say you buy it at $1.50. In this case, you're going to want to look at a cash secured put in the future that's down, lower than 25, and out later in the future, and try to get at least $50 on this transaction in order to have a net credit. So for instance, let's say it's 2 months out because the stock price went down quite a bit. We might have to sell it 2 months out and maybe get $75 on the new cash secured put. So then you'll still be at a net positive in the transaction. Okay, now at this point, let's say that we are keeping this going It's just not worth it, though, to go down and out. You might have to go out 6 months before it's worth it. At this point, you're going to get a sign, okay? If you get a sign at this point, you're going to continue the wheel strategy by selling a covered call and make sure your strike price is over the cost basis that we figured out in step 3. Okay? Just like before, if you're close to a sign near the expiration, let's say that you had the current stock price at 35, you sell a covered call at 40, and it goes up to 40 in 2 days, even though you have another month out. At that point, you might want to buy to close that covered call, and then sell another one up and out instead of down and out, just like we looked in the cash secured put part on the animation I showed. Consider if you're in an ex-dividend date, though, because you might still receive a dividend, or you could push out your expiration to make sure that you're getting the dividend payment, especially for, like, say, AT&T that pays a 7% dividend. It might be worth it to buy to close, sell a future covered call out, and then get your premium as well. If you're not assigned, sell another covered call strike price, again, below cost basis, and then just continue the wheel from there. So everything I wrote in blue is a little bit more advanced. You don't necessarily have to do the stuff in blue, but it might help manage your position more and receive more returns. Here's some other thoughts to consider, and if you'd like me to, leave a comment down below, and I might make another video on these. Let's say you receive a 75 or higher % gain right away. You might want to consider to buy to close it and then enter a new position. Let's say you make $50 premium on a cash secured put, and then you could buy to close it at 10 cents literally a week later because the stock just shot way up. It's not going to be worth much money anymore. At that point, it might be worth it just to buy to close and then look for another opportunity. Instead of waiting 3 weeks just to get, say, $10, you could do possibly better by just going out and out. I've been doing this a little bit in my trading, about 75% gain. For Bank of America, I literally made that in a day and a half because the stock went up about 4% last week in one day. So I just bought to close it and then another one out. If you didn't receive 75% gain in a few weeks, consider leaving that trade to expire and then just do it again. Again, stock price at 30, so cash secured put at 25. It gets very slowly to 29, slowly to 28, then it's near 27. You're going to be gaining your theta, essentially the time decay, relatively stably at that point, but you're not going to get a huge jump in your premium right away. In that case, you probably just want to let it expire, okay? And that's more of an art than a science, I think. I think 75% is a pretty good gain as long as you get it relatively quickly. And lastly, try to do this in a Roth IRA, because if you do this in a Roth IRA, you will not have any tax implications. If you do this in a regular brokerage account, you would need to pay pretty hefty taxes on your capital gains because it's considered short-term capital gains. Next, let's look at an example using wheel strategy for a pretty volatile stock with a high implied volatility. So a list of cash secured puts that I've been considering. One of them is PLTR, Palantir Technologies, which has a very high implied volatility. Right now we're on Monday, December 7th. And PLTR is up 10% just today. The stock has been moving quite a bit up and down. It had a lot of down days last week, bounced back up to where we are again. So the option trade on this one's going to be moving quite a bit. See that big drop down, big drop back up, and it's shooting up again. So let's say we're going to do this for PLTR. I like looking at CBOE, that is a Chicago Board of Exchange, that shows actual quotes for whatever you'd like. So let's look at Palantir. Palantir, again, is a very volatile stock, been making big moves up and down, so you might be getting bigger premiums on this particular stock compared to others. And of course, internet is being slower than I need to. So all right, so we look at Palantir on January 22nd, which is about 45 days out in expiration. You could sell a 22 cash secured put. The last trade was 3.26. It's moving quite steadily here, but let's just assume that I could get $3.26 in the cash secured put. We're going to write this on our wheel strategy for PLTR. It'll be 3.26. Total receipt, $326. I can leave it open. Obviously, that's my profit so far. And then that particular option is at 22. Right now, PLTR is at 26 or so. So it's a bit out of money. Again, 30% delta. It's a typical number you want to look at because you want to keep your shares. It's a 0.28 delta at this point. And then what you could do is wait until January 22nd. If it doesn't get down to 22, you would have earned $326. Let's say it goes even higher to $45 or so. This particular option will be pretty much worthless. You could buy it at close at 10, 15 cents, and then rinse repeat it. Okay. If the stock goes way down, let's say down to 20, you'd want to buy that position and then sell another call out and down. Okay. And this is the Investing Teacher. If you have any questions, let me know. Comment down below. I read all comments. Like, subscribe, all that good stuff. And again, this is a more advanced strategy. I wouldn't necessarily do this unless you're pretty confident in selling cash secured puts and covered calls. If you have any questions, let me know, and I'll see you guys next time.